As silver moves closer to levels that once seemed abstract, the real pressure does not emerge in headlines or price charts. It emerges inside the mechanics of the market itself. This is where readiness is tested, not by belief, but by structure. And it is here that silver begins to expose how much of the modern market is built on assumptions rather than capacity. Silver is not a large market by global financial standards. Its annual production, investable stock, and daily liquidity are small relative to equities, sovereign bonds, or even gold. Yet layered on top of this limited physical base is a vast structure of paper claims. Futures contracts, options, exchange-traded products, and unallocated accounts collectively represent many multiples of the metal that actually exists. This imbalance functions smoothly only as long as price remains contained and volatility predictable. As price rises, that balance becomes more delicate. Margin requirements adjust upward. Volatility models reprice risk. Participants who have relied on historically low variance discover that their positions require more capital simply to maintain. This is not a failure of the system. It is the system doing exactly what it was designed to do. But design does not guarantee comfort. What makes silver different at this stage is that higher prices do not automatically bring new supply online. Mining output responds slowly, if at all. Recycling flows are incremental. Inventories that once acted as buffers are finite. This means that price increases primarily redistribute stress rather than resolve it. They shift pressure from one balance sheet to another. In leveraged markets, this redistribution matters. A position that was manageable when silver traded comfortably, below stress thresholds, can become unstable as those thresholds are approached. Not because the position was irrational, but because the environment has changed. Liquidity that once appeared deep becomes selective. Market makers widen spreads. Financing costs rise. What was once assumed to be continuously tradable becomes episodic. This is where the phrase, "the market isn't ready," takes on meaning. Readiness is not about sentiment. It is about whether the system can absorb higher prices without forcing disorderly adjustments. That depends on leverage, collateral quality, and the willingness of participants to extend liquidity under stress. These factors cannot be conjured quickly. They are either present or they are not. Silver's approach toward $100 also intersects with a broader macro backdrop that amplifies sensitivity. Sovereign debt issuance continues at historic scale. Central banks are more constrained in their responses. Real yields remain volatile. In such an environment, assets that sit outside traditional credit structures attract attention precisely because they do not depend on policy credibility. At the same time, this is not a one-sided story of shorts under pressure. Long holders face their own tests. As price rises, questions shift from conviction to custody, from exposure to exit strategy. Physical holders confront liquidity trade-offs. Paper holders confront counterparty exposure. Each form of ownership behaves differently under stress, and those differences matter more as price approaches psychologically and structurally significant levels. This is why following silver purely as a price narrative misses the point. The more important story is how participants adapt as assumptions are challenged. Who reduces exposure quietly? Who adds protection? Who discovers that their models did not account for this regime? If this kind of analysis focused on structure rather than excitement is how you prefer to understand markets, this is where subscribing becomes useful. These shifts rarely announce themselves clearly, and they tend to matter most before consensus forms. The key insight is that silver nearing $100 is not a destination, it is a transition zone. Markets are most fragile not at extremes, but as they approach them. That is when leverage is revealed, liquidity is tested, and confidence becomes conditional. To see how this process typically resolves, we need to examine what happens when physical availability, not just price, begins to influence behavior and why that distinction has historically mattered more than any headline number. Another layer of unpreparedness sits in how silver has been modeled over the past decade. For most institutional frameworks, silver has been treated as a low volatility adjunct to gold, or as an industrial input whose price action could be smoothed through hedging and derivatives. Those assumptions were formed in an era of abundant liquidity, suppressed rates, and reliable backstops. They begin to fail as conditions tighten. As silver approaches higher price regimes, correlations that once felt stable begin to loosen. Silver no longer behaves purely as a secondary precious metal, nor purely as an industrial commodity. It begins to trade as a stress asset, reacting to liquidity conditions, currency credibility, and confidence in settlement systems. That transition is uncomfortable for participants whose risk controls are backward-looking. One of the least discussed pressures is collateral substitution. As volatility rises across traditional assets, high-quality collateral becomes scarce. Assets that can be rehypothecated repeatedly lose appeal when haircuts rise and counterparties become selective. In these moments, physical assets that sit outside the collateral chain regain relevance not because they can be leveraged easily, but because they cannot be impaired by someone else's balance sheet. Silver's relatively small market size magnifies this effect. It does not take dramatic flows to create stress. A modest increase in delivery demand, a reluctance to lend metal, or a preference for physical settlement can tighten conditions quickly. These shifts rarely appear dramatic in isolation, but together they change how the market functions. This is why readiness cannot be measured by open interest or trading volume alone. A market can appear active while becoming brittle. Liquidity can exist until it is needed most. The test only arrives when participants attempt to reduce exposure simultaneously, or when delivery preferences change at the margin. Importantly, this phase does not require panic. It only requires caution. When participants begin to question assumptions about liquidity, settlement, or counterparties, they adjust behavior quietly. Positions are resized. Optionality is rebuilt. Risk is redistributed. These actions are rational responses to uncertainty, not emotional reactions. Silver nearing $100 compresses time. Adjustments that could have been made gradually are forced into shorter windows. This is when systems reveal whether they were designed for stability or merely optimized for calm. The market's lack of readiness is not a flaw unique to silver. It is a feature of transitions. And it is precisely during these transitions that signals matter most. To understand how these pressures translate into broader consequences, we need to examine how trust, once strained, reshapes behavior across financial and physical markets alike. Trust does not disappear in markets through sudden revelation, it erodes through repeated exceptions. Each time a system behaves differently than expected, participants make small adjustments. Over time, those adjustments compound into structural change. This is the stage silver is entering now, where price becomes less important than reliability. As silver moves higher, the question facing participants is no longer whether demand exists, but what form that demand takes. Paper demand is elastic. It can expand and contract rapidly, settle in cash, and disappear without consequence. Physical demand is not. It requires sourcing, delivery, storage, and finality. When the balance between the two begins to shift, the market behaves differently. This distinction matters because the silver market is not designed for widespread physical preference. The infrastructure assumes that most exposure will remain synthetic. Vault inventories, lease markets, and delivery mechanisms function smoothly only when physical claims remain marginal. When they do not, friction appears. History shows that this friction does not announce itself through price alone. It shows up in delays, premiums, and changing terms. Participants become less willing to lease metal. Settlement preferences shift. What was once routine becomes negotiable. These are early signs of trust being repriced. At the same time, trust in broader financial systems is under quiet pressure. Payment rails are more regulated. Capital flows are more conditional. Sanctions and compliance regimes have expanded the concept of counterparty risk. These developments do not cause immediate disruption, but they alter behavior at the margin. Silver benefits from this environment because it does not depend on trust in any single institution. It is not a promise. It is a possession. That distinction becomes relevant when participants begin to question not whether markets will function, but under what conditions they will function. This is why silver's behavior at higher prices often feels different than expected. It stops responding cleanly to traditional signals. It begins to reflect broader questions of confidence and access. Participants who understand this do not wait for confirmation. They adjust early. What makes this phase challenging is that it does not produce clear validation. Markets can remain orderly while trust is being reallocated. Prices can consolidate while underlying assumptions change. Those looking for dramatic confirmation often miss the transition entirely. The silver market's approach toward $100 forces these dynamics into view. It compresses years of complacency into months of adjustment. Participants discover which risks were theoretical and which were structural. This is the point where observation matters more than prediction. Watching how participants behave, how they settle, how they hedge, how they adjust custody reveals far more than any price target. To understand what comes next, we need to examine how these shifts in trust interact with physical supply, industrial demand, and the limits of production. Because confidence can adjust gradually. Supply cannot. As trust is repriced, attention shifts naturally from markets to materials. Financial systems can adapt through policy, leverage, and narrative. Physical systems cannot. Silver's role as both a monetary asset and an industrial input places it directly at the intersection of this constraint. And it is here that readiness is tested most clearly. Industrial demand for silver has changed in character. It is no longer tied solely to cyclical manufacturing or discretionary electronics. It is embedded in energy infrastructure, grid expansion, electrification, and advanced technology. These uses are structural, not optional. They persist even as economic conditions fluctuate, and in some cases they intensify during periods of transition. Supply, by contrast, remains inelastic. Silver production responds slowly to price signals. Many silver ounces are produced as byproducts of base metal mining, meaning output is governed by the economics of copper, lead, and zinc rather than silver itself. This limits the market's ability to respond quickly when demand shifts. As silver approaches higher price regimes, this imbalance becomes harder to ignore. Physical availability begins to matter more than theoretical supply. Above-ground inventories, once treated as passive buffers, become active variables. When those inventories are drawn down or withheld, price alone cannot resolve the tension. This is where readiness becomes a physical question. Can the market deliver metal in size, at speed, and without disruption? Or has the system evolved around the assumption that delivery would rarely be tested? These questions do not have to be answered publicly to influence behavior. They are answered privately through decisions about leasing, hedging, and custody. At higher prices, industrial users face a different set of pressures. Hedging costs rise, budget assumptions are challenged. Substitution becomes tempting but often impractical. The result is a cautious approach that prioritizes supply assurance over price optimization. This behavior further tightens availability. Financial participants observe these shifts and adjust accordingly. When physical demand becomes less flexible, the margin for error narrows. Leverage that once appeared manageable becomes risky. Exposure that relied on liquidity assumptions is reconsidered. This interaction between physical constraint and financial structure is what makes silver's current move significant. It is not simply a function of demand. It is a function of limits. Markets are efficient at pricing growth. They are far less comfortable pricing scarcity. If you find value in tracking how these physical constraints interact with financial systems, this is where subscribing makes sense. These dynamics develop quietly, long before they are reflected in consensus narratives. The approach toward $100 forces the silver market to confront realities it has been able to defer for years. Readiness is no longer theoretical, it is operational. To understand how these pressures resolve, we need to examine what happens when markets attempt to rebalance under constraint, and why the outcome is rarely symmetrical. The final phase of any market transition is not marked by a peak, a crash, or a headline. It is marked by normalization. What once felt extreme becomes incorporated into behavior. Risk models adjust, language shifts. Participants stop asking whether something can happen and begin asking how to operate if it does. This is where silver now sits as it nears levels the modern market has never had to inhabit. The question is no longer whether silver can trade near $100. The question is whether the system built around silver was designed for that environment. Markets do not fail because prices rise. They struggle when price rises faster than structure can adapt, and structure adapts slowly. Over decades, the silver market evolved to function under conditions of relative abundance and suppressed volatility. Leverage became normalized. Paper claims multiplied because they were rarely challenged. Physical settlement was treated as an edge case rather than a core function. That framework worked as long as silver remained contained within a familiar range. As that range is exited, the assumptions embedded in the system are exposed. This exposure does not require dramatic failure. It shows up as friction, as hesitation, as a reluctance to extend liquidity on the same terms as before. Participants become more selective about counterparties. Financing becomes more conditional. Inventory that once circulated freely becomes anchored. None of these developments are visible in a single data point. Together, they redefine how the market behaves. Importantly, this is not a story of inevitability. There is no guaranteed outcome. Markets are adaptive. They can reprice risk, reduce leverage, and restructure incentives. But adaptation has a cost. It redistributes pressure. Some participants adjust early and quietly. Others are forced to adjust later and publicly. Silver's dual role intensifies this process. As a financial asset, it reflects confidence and liquidity conditions. As a physical input, it reflects supply constraints and industrial necessity. When both dimensions tighten simultaneously, the margin for error narrows, price becomes less forgiving. Small imbalances carry larger consequences. This is why the phrase, "the market isn't ready," matters. It does not imply collapse. It implies misalignment between price, positioning, and capacity. Readiness is about whether the system can absorb stress without amplifying it. That depends not on optimism, but on preparation. Historically, periods like this resolve through one of two paths. Either the market adjusts gradually, redistributing exposure over time, or it adjusts abruptly through forced repricing. The difference between the two is not foresight. It is flexibility. Systems with room to maneuver tend to absorb transitions. Systems optimized for efficiency struggle when conditions change. Silver nearing $100 compresses that choice. It accelerates decisions that could once be deferred. It forces participants to confront questions about leverage, settlement, and physical access that were easy to ignore at lower levels. In doing so, it acts as a diagnostic tool for the broader financial environment. The broader implication extends beyond silver. Markets across asset classes are grappling with similar dynamics. Liquidity is more conditional. Policy backstops are less automatic. Trust is still present, but it is no longer unconditional. Assets that reveal these shifts early often appear volatile or uncomfortable before they appear prescient. For observers, the value lies not in predicting outcomes, but in recognizing regimes. When behavior changes quietly, it is often more important than when narratives change loudly. Silver's current position reflects a system in transition, not one in resolution. If you've been watching these shifts across other markets, whether in metals, currencies, or credit, share your perspective in the comments. Comparing signals across systems often reveals patterns that isolated analysis misses. And if this kind of structural, behavior-focused approach adds clarity to how you interpret market moves, consider sharing it with others who look beyond headlines and price targets. The story of silver nearing $100 is not about a milestone. It is about preparedness. Markets are rarely surprised by outcomes. They are surprised by timing. And timing is dictated not by belief but by structure.